Sanctions are meant to be a powerful economic weapon. They are designed to isolate a nation, to cut off its revenue streams, and to force a change in its behavior. When imposed on an oil-producing country, the goal seems straightforward: stop its oil from reaching the global market. This action should, in theory, reduce the global supply and punish the sanctioned regime by choking off its primary source of income. Headlines announce the move. Diplomats give firm statements. The world believes millions of barrels are off the table, but that perception is often an illusion. The oil doesn't vanish. The reality is more complex and, for some, more profitable. Sanctions don't stop oil. They change how it's sold. The flow of crude continues, but it is diverted into the shadows, away from transparent, regulated channels. This is the world of sanctioned oil. At its core, it's crude or refined products from a country under restrictions: Venezuela, Iran, Russia, because it can't be sold openly. It moves through a hidden parallel system to bypass rules, a cat-and-mouse game on the high seas and in clandestine boardrooms. To entice buyers for the legal and reputational risk, sellers offer steep discounts. $100 on the open market could sell for $70 and $80 in the shadow economy. That discount unlocks the system. It creates massive financial incentives for players outside the lines. The discounted price isn't a loss for the sanctioned nation. It's the cost of doing business under pressure. For facilitators, that discount is a potential windfall. Not scarcity, but redirection. A policy meant to punish inadvertently creates a lucrative black market. That market undermines sanctions and affects global energy prices, market stability, international security. It enriches operators who thrive on opacity and risk. While governments announce tough stances, hidden winners quietly capitalize. Oil keeps flowing. Profits reroute to those navigating murky waters out of public view. So, who exactly are these hidden winners? Who profits when a barrel of oil is forced underground? To answer that question, we need to follow the money trail. The journey begins with the discounted barrel. It passes through many hands, finally consumed as gasoline in your car or fuel for a power plant. Each person in this chain takes a cut, turning the risk they bear into a substantial reward. It's a complex ecosystem of opportunists: shipowners, traders, brokers, established refiners. The first group to benefit is the owners of the shadow fleet. These are shipping companies, hidden behind shell corporations in lax jurisdictions, operating aging tankers. They specialize in transporting sanctioned cargo because they engage in deceptive practices, turning off transponders to go dark, falsifying documents, risky ship-to-ship transfers at sea. They can charge a premium. They absorb risk of seizure or blacklisting. In return, they earn freight rates double or triple the market, making immense profits on each clandestine voyage. Next in line are the traders and intermediaries. These are the deal makers who connect the sanctioned seller with the willing buyer. A trader might purchase the discounted oil directly, using their network and finance to arrange complex logistics. They buy low, rebrand the oil, blend the oil to obscure origin, then sell high. Intermediaries or brokers may not take ownership themselves, but they facilitate the transaction, handling paperwork, arranging financing, connecting players, taking a percentage of the deal's value. In a multi-million-dollar deal, even a small percentage is a significant payday. Finally, the trail leads to the refiners. Major Western refineries won't touch sanctioned oil, but others look the other way. Refiners in jurisdictions with lax enforcement or politically aligned with the sanctioned nation see an opportunity. By purchasing discounted crude, they can significantly lower production costs. They produce gasoline, diesel, other petroleum products more cheaply than competitors, boosting profit margins on finished fuels. This journey matters to everyone. It distorts markets, creates volatility, and impacts the prices we all pay at the pump. The journey of sanctioned oil begins not with a ship, but with a number. This number is the discount, the crucial incentive that makes the underground system work. A sanctioned country, like Venezuela, Iran, finds itself locked out of the legitimate global market. Major trading houses, international banks, reputable shipping lines will not do business with them. They have no choice but to offer it at a significantly lower price than the global benchmark, such as Brent crude. This discount is not a sign of poor quality oil. It is the price of secrecy, a payment to the buyer for the risk they're about to take, a financial carrot for a select group of traders and intermediaries who are willing to step into the shadows. Imagine a barrel trading at $100 on the open market. A sanctioned producer might offer that same barrel for $70 or $80. For a buyer, it's an irresistible proposition, a guaranteed profit margin from the start if they can navigate the labyrinth of restrictions. The discount must be substantial enough to cover the extra costs and dangers. Hiring specialized, expensive shipping, paying for extra insurance, forgoing insurance entirely, budgeting for potential fines or losses if caught. The seller subsidizes the clandestine supply chain, paying everyone, shipowner, broker, to break the rules. The initial transaction is shrouded in obscurity. It doesn't happen on a public exchange. It's arranged through a small, trusted network of brokers and shell companies. These entities act as a firewall between the sanctioned state and the world. Payments are complex, often avoiding the US dollar and major Western banks, flowing through regional banks in friendly countries, or using alternative financial systems. The goal: make the money as hard to trace as the oil. The discount fuels the engine, motivating every player in the high-stakes game. For the sanctioned nation, selling at a discount is a painful necessity. Less revenue for government and people, but better than complete economic collapse. $70 for a barrel is far better than zero. The constant flow of discounted oil keeps the regime afloat, pays security forces, and maintains basic state function. The paradox: the discount that breaks sanctions also helps the country endure them. A compromise born of desperation, creating a powerful, profitable underworld for the bold. Once a deal for discounted oil is struck, the next challenge is transportation. This is where the shadow fleet comes into play. This is not a formal, organized navy, but a sprawling, ever-changing collection of oil tankers operating outside the bounds of international law and industry norms. These ships are often older, nearing the end of their service life. The ownership is deliberately complex, hidden behind layers of shell corporations registered in jurisdictions like Panama and Liberia. The true beneficial owners are almost impossible to identify, making it difficult to hold anyone accountable. These vessels are the workhorses of the sanctioned oil trade. Mainstream shipping companies, which rely on Western insurance, financing, port access, will not touch this cargo. The risk of being blacklisted by the U.S. Treasury Department is too great. It would be a corporate death sentence. Owners of the shadow fleet, however, embrace this risk. They operate in a parallel universe, often forgoing standard insurance. Instead, they might get alternative coverage from Russian providers, Chinese providers, or simply sail without adequate insurance, a terrifying prospect given the environmental danger of an oil spill from an aging, poorly maintained tanker. Because they are taking on such immense risk, the owners of these shadow vessels can command exorbitant fees. Their freight rates can be 2 times higher, 3 times higher. This premium is the reward for their willingness to operate in the dark. A single voyage carrying 2 million barrels of sanctioned crude can generate millions of dollars in pure profit for the shipowner. This has created a booming market for second-hand tankers. Vessels that would have otherwise been sent to the scrapyard are being snapped up at inflated prices, given a fresh coat of paint, and put back into service to carry sanctioned cargo. The rise of the shadow fleet is a direct consequence of sanctions. As more countries have come under restrictions, the demand for these clandestine shipping services has exploded. Experts estimate that hundreds of tankers now make up this fleet. These ships are constantly changing names and flags to evade detection. A vessel might start its journey as the Sea Eagle flagged in Panama and arrive at its destination as the Mariner King flagged in Cameroon. This constant identity swapping is a core tactic, making it a nightmare for authorities to track a specific ship's history and activities, allowing the oil to move one step closer to its final destination. Section 3. Going Dark: The Art of Vanishing at Sea. A key weapon in the Shadow Fleet's arsenal is the ability to simply disappear. All commercial vessels over a certain size are required to continuously broadcast identity, position, and course via AIS. Automatic Identification System, AIS. This system is crucial for safety, helping prevent collisions at sea. It also provides transparency. Governments, port authorities, commodity traders. For a ship carrying sanctioned oil, however, this transparency is the enemy. At critical moments, they do something forbidden. They switch off their AIS transponders. They go dark. Going dark is a huge red flag for authorities, but remarkably effective. A tanker might steam across the Indian Ocean toward Singapore. Then suddenly, its signal vanishes. For days or even weeks, the ship is a ghost. During this electronic silence, illicit activity often takes place. The ship might divert to a sanctioned country's port to load hidden cargo, or rendezvous with another vessel for a ship-to-ship transfer. When it reappears hundreds of miles away, records will show a seamless journey, no indication of the illegal stop. This practice is incredibly dangerous. A massive oil tanker without a transponder is invisible to other ships' navigation systems. Risk of catastrophic collision, especially in busy shipping lanes. For the captain and crew, following orders is not a choice. Financial incentives are too powerful. The chain of command is absolute. Going dark is a calculated risk, trading safety for secrecy. Satellite surveillance and data analytics firms are in a constant cat-and-mouse game. They use technologies like synthetic aperture radar, SAR, to try to find dark vessels, but it's like finding a needle in a vast oceanic haystack. Once cargo is loaded, the ship may stay dark until far from the sanctioned region. When it switches AIS back on, it may broadcast a new, false destination. Example: loaded oil in Iran, reappears in the Strait of Malacca. Signals coming from Iraq, or signals coming from Oman. The digital breadcrumb trail has been broken. The ship's AIS history now contains a critical gap. This gap is where the crime took place, hidden from view. For enforcement, the blank spot is a dead end, allowing oil to continue under a cloak of digital invisibility. Section 4. Ship to Ship. A shell game on the ocean. Going dark is often the prelude to the ship-to-ship transfer. This practice is the linchpin of the sanctioned oil trade, a shell game played on the high seas. A ship-to-ship, or STS, transfer is exactly what it sounds like. Two tankers meet in a quiet area of the ocean, often just outside the territorial waters of any country, and pump cargo from one vessel to the other. While STS transfers can be legitimate operations, in the world of sanctioned oil they are used to obscure the cargo's origin. It's a way of laundering the oil, making it appear as if it came from a legitimate source. Here is how a typical scenario plays out. Vessel A loads crude oil at a sanctioned port in Venezuela. Vessel A sails to a pre-arranged location off the coast of Malaysia, off the coast of West Africa, and goes dark. Vessel A meets Vessel B. Vessel B may be an aging ship from the Shadow Fleet or a seemingly legitimate tanker that has falsified its own records. Under the cover of darkness, the two ships pull alongside each other. Hoses are connected for transfer. This is a hazardous operation, especially in open seas with older ships, risking spills and accidents. After the transfer is complete, Vessel A may sail away empty to pick up another illicit load. Vessel B, now full of sanctioned oil, can create a new, false history for its cargo. The captain can claim the oil was loaded from a different ship, or even from a legitimate floating storage facility. The new paperwork will list a non-sanctioned country like Malaysia, like Oman, as the oil's country of origin. This blending and rebranding is crucial. Sometimes the sanctioned oil is mixed with a small amount of legitimate crude to further confuse any chemical analysis that might be used to trace its source. This tactic makes enforcement incredibly difficult. By the time the oil reaches its final destination, it has been passed between multiple ships, its documentation has been altered, and its physical properties may have been changed. It arrives at a refinery in Asia, for instance, with papers that look perfectly legitimate. The buyer can claim plausible deniability, stating they purchased a cargo of Malaysian blend in good faith. The STS transfer effectively severs the chain of custody, creating a firewall between the sanctioned producer and the end user. It's a simple but highly effective method for washing the oil clean of its forbidden origins. Section 5. The final masquerade: forged papers and false flags. The last step in smuggling sanctioned oil is a believable cover story, a final masquerade of forged documents and deceptive flagging. The physical movement of the oil is only half the battle. The shipment must also come with a trail of paperwork that survives casual scrutiny. Bill of lading, certificate of origin, insurance papers. These documents are systematically falsified to create a new identity for the cargo. After a ship-to-ship transfer, the new vessel needs matching paperwork. Intermediaries and specialized brokers in discrete trading hubs create these documents. They generate certificates claiming the oil is from a non-sanctioned country. Example: Iranian oil off Malaysia documented as Malaysian light crude. Bills of lading are altered to show false ports of loading. That paper trail helps the cargo pass customs and financial checks. Another tactic: flag hopping. A ship's flag decides which laws it follows. Flags of convenience offer fast, low-overhead registration. Starts under a Panamanian flag, re-registers in Comoros, or Gabon. The ship gets a new name and new flag, a new vessel on paper. That makes blacklists and long-term tracking extremely hard. Forged papers plus false flags complete the laundering process. The oil, bought at a deep discount from a sanctioned port, is now disguised. A phantom ship vanished and reappeared. Cargo shuffled in a mid-ocean shell game. Identity rewritten with fake documents. It's ready to be sold to a refiner at near market price. Massive profit shared among the shipowner, the trader, the broker, and the refiner. Section 1. The shadow shipowners, kings of the clandestine seas. At the very heart of the sanctioned oil trade are the shipowners, the shadowy figures who provide the most critical piece of the puzzle: transportation. Not the heads of major publicly listed shipping giants. Operators who thrive in obscurity, controlling a growing shadow fleet of tankers. These shipowners are arguably the biggest direct financial winners in this high-stakes game. Their business model is simple. They take on risks no legitimate operator would consider, and in return, they charge astronomical fees. Gatekeepers of clandestine sea lanes, the price for passage is steep, creating immense personal fortunes from the chaos of global sanctions. They profit by charging massive premiums on freight rates. Legitimate charters are set by supply and demand. For shadow vessels, the calculation is different. Rates must cover the danger of a vessel being seized, blacklisted by the U.S. Treasury, or denied access to major ports and services. A shadow tanker might earn double, triple, or even quadruple the standard rate. That risk premium becomes pure profit for each successful delivery. Example: a standard voyage might cost $3 million. A shadow operator could demand $9 million. The extra $6 million is payment for deceptive practices like turning off transponders and falsifying records. This fuels demand for older, second-hand tankers. Ships bound for scrap yards are bought at inflated prices by anonymous shell companies. Owners can recoup investments in 1 or 2 voyages, with subsequent trips nearly all profit. These ship owners are masters of corporate obfuscation, identities hidden behind layers of shell companies in secrecy-friendly jurisdictions. A vessel owned by a Panama company, owned in turn by an entity in the Marshall Islands until the trail goes cold, designed to make identifying the true owner nearly impossible. They operate with impunity. If one ship is caught, discard the asset and the shell company and continue operations with other vessels. They are the new kings of the sea, reigning over a ghost armada that serves the sanctioned markets. Section 2. The risk-hungry traders, masters of the margin. If ship owners control the transport, traders orchestrate the deals and profit from the price differential. Not your typical Wall Street traders. Smaller, more agile, more secretive, based in trading hubs like Dubai or Singapore. High tolerance for risk and a deep network of contacts. Their business model: arbitrage, buying low, selling high. Sanctions discounts create the opportunity. They buy discounted crude from sanctioned nations, then sell it back into the market at higher prices. Profit comes from the spread between purchase price and sale price. For example, a trader negotiates a cargo of Venezuelan crude at a $30 discount to a $100 benchmark, buying at $70, all-in cost after shipping and insurance, $78 per barrel. They find a buyer, maybe a private refiner in Asia, who pays $95 per barrel. On 2 million barrels, $17 per barrel margin, start a $34 million profit. Traders become masters of logistics in disguise. They charter shadow fleet vessels and coordinate ship-to-ship transfers. They create forged documents to rebrand oil origin. They might buy Iranian crude, blend with Iraqi oil at sea, then market it as Basra Light. Requires deep operational knowledge and operating in a legal and ethical gray area. They take big financial risks. If a cargo is seized, the loss is entirely theirs. But rewards attract a steady stream of players. They use web of front companies to obscure involvement. Financed through one entity, shipping arranged by another, final sale by a third. This compartmentalization thwarts authorities. They see sanctions as market inefficiency, not politics. While governments isolate regimes, these traders do the opposite, building the bridges that allow sanctioned oil to flow and collecting a handsome toll along the way, you know. Section 3. The intermediaries, architects of the deal. Between the sanctioned seller and the risk-hungry trader lies a crucial network of intermediaries, brokers, consultants. These are the architects of the deal, the facilitators who may never actually own the oil, but whose services are indispensable. They are the ultimate middlemen, connecting sellers with buyers, arranging financing, and managing the deceptive paperwork required to keep the operation afloat. For their services, they take a commission or a flat fee. While their cut may be smaller than a trader's outright profit margin, it is a low-risk way to make millions of dollars from the illicit trade. One of the primary roles of an intermediary is matchmaking. A sanctioned state's national oil company cannot simply post an offer on a public exchange. They rely on brokers with trusted contacts to discreetly find potential buyers. Brokers leverage personal networks built over years in the murkier corners of the oil industry. They vet the parties, negotiate the terms of the discount, and structure the deal to minimize risk. They might charge a commission of $1 or $2 per barrel. On a 2 million barrel tanker, that equals a $2 to $4 million fee, making a few phone calls and introductions. Another critical function of intermediaries is document fabrication. Once a deal is structured, the cargo needs a plausible, legitimate-looking paper trail. Specialized agents create forged bills of lading, certificates of origin, and insurance documents. They might operate out of free trade zones or corporate service firms in discrete jurisdictions. They know what customs officials or bank compliance officers look for. They create documents designed to pass inspection. This service launders the oil's identity, and paperwork specialists charge a high price. Finally, intermediaries help arrange the complex financial flows. Since these transactions cannot move through major Western banks, payments are routed through alternative channels. They set up accounts at regional banks in friendly countries. They facilitate currency swaps to avoid the US dollar, or arrange payment through barter systems or obscure cryptocurrencies. They are the financial plumbers of the shadow economy, creating pathways for hundreds of millions to move without triggering alarms. By piecing together the logistical elements, documentary elements, and financial elements of the puzzle, intermediaries profit handsomely without ever touching a drop of oil, and they remain essential to the whole operation. Section 4. The compliant refiners. The journey of sanctioned oil ends at a refinery, where the crude is processed into valuable products like gasoline, diesel, jet fuel. While major international oil companies and refiners in North America and Europe will not touch this oil due to legal and reputational risks, a subset of refiners in Asia has become the final destination. These are the compliant refiners, willing to look the other way and accept discounted crude. They keep the illicit supply chain moving and gain a significant competitive advantage and bigger profits. The primary benefit is access to cheaper feedstock. A refinery's profit margin is largely determined by the crack spread, the difference between crude purchase price and refined product price. By buying sanctioned crude at a discount of, say, $15 per barrel, $20 per barrel, refiners lower their biggest cost. That yields much higher profit margins than competitors buying on the open market. This cost advantage is a powerful incentive in the low-margin refining business. These refiners often claim plausible deniability. The oil arrives with documents saying it's from a legitimate source, like Malaysia or Oman. Refineries can claim they bought in good faith based on the paperwork. But in reality, it's often an open secret. The traders offering these discounted barrels are known, and the unusually low price signals dubious origin. As long as the paperwork gives a thin veil of legitimacy and the home government isn't enforcing sanctions, the business continues. Some of the largest buyers are independent teapot refiners in China, which are primary outlets for Iranian crude and Venezuelan crude. By buying this oil, refiners increase profitability and provide the final sink for sanctioned barrels, ensuring steady revenue for producers. The refined products from this cheap crude are sold into the domestic market and the international market at full price. Consumers in those regions may not see any discount at the pump. Instead, the refiner captures the entire financial benefit. They are the final link in the chain of profit, turning a blind eye for a healthier balance sheet and a stronger edge over competitors. Section 5. The enablers, insurers and financiers in the gray zone: shipowners, traders, refiners. These primary actors are supported by a cast of secondary enablers who operate in the financial and legal gray zones: alternative insurance providers, niche financial institutions. The mainstream, reputable firms in London, New York, Geneva will not provide insurance, financing, or legal services for these deals. That has created a parallel ecosystem of providers who are willing to step in, and they profit at a premium. Insurance is a critical component of any maritime voyage. The leading providers are the London-based international group of P&I clubs. They insure about 90% of the world's shipping. These clubs will not cover vessels engaged in sanctions evasion. This void has been filled by new or less-known insurers, often based in Russia or China, that are not beholden to Western sanctions. These providers offer an alternative for shadow fleet owners, allowing them to get coverage to operate. The risk profile is so high, older, poorly maintained, and engaged in dangerous maneuvers. Insurance premiums are exorbitant, creating a profitable niche for these alternative underwriters. Similarly, financing these multi-million-dollar deals requires banks willing to handle the funds. Major international banks with U.S. correspondent accounts have compliance teams that would flag and block such transactions. To get around this, traders and intermediaries. Turn to smaller regional banks in jurisdictions friendly to the sanctioned state, or jurisdictions with weak anti-money laundering enforcement. These financial institutions may charge higher fees and demand more complex arrangements, but they move the money. They profit from transaction fees and by holding large deposits, becoming the bankers of the shadow economy. Lawyers and corporate service agents also play a role and profit from the complexity. Setting up the labyrinth of shell companies to hide ship ownership requires legal expertise. Firms specializing in offshore incorporations in Panama, Liberia, and the Marshall Islands facilitate anonymous entities for a fee. They provide nominee directors and registered addresses, further obscuring the true owners. These enablers provide the essential lubricant that keeps the machinery of the sanctioned oil trade running smoothly. They may not be on the front lines, but they are an integral part of the profit chain, capitalizing on the need for secrecy and financial discretion. Section 6. The Sanctioned State. Surviving on the discount. It may seem counterintuitive, but one of the key beneficiaries of this shadow market is the sanctioned state itself. While sanctions are designed to cripple their economy and choke off their revenue, the underground system provides a vital lifeline. Selling oil at a steep discount is far from ideal. It represents a significant loss of potential income for the country. However, in a situation where the alternative is selling no oil at all, a discounted sale is a victory. The revenue generated, even if it is only 60 or 70 cents on the dollar, is often enough to keep the regime in power, fund its security apparatus, and prevent a complete collapse of the state. This flow of cash allows the sanctioned government to maintain a basic level of control and stability. It provides the foreign currency needed to import essential goods, like food, medicine, and less essential items needed to placate key constituencies. For regimes in Venezuela, Iran, Russia, the ability to continue exporting, even through these illicit and inefficient channels, is a matter of political survival. The shadow market therefore directly undermines the primary goal of sanctions, which is to apply enough economic pressure to force a change in the regime's behavior or policies. Moreover, by participating in this trade, the sanctioned state develops a resilient and sophisticated network for evading international pressure. It becomes adept at using shell companies, navigating alternative financial systems, and leveraging geopolitical relationships with countries willing to defy the sanctions. This builds a form of economic resistance that can be used to withstand future pressure. The state's national oil company and its associated trading arms become experts in clandestine logistics, a skill set that makes them harder to isolate. This institutional knowledge is a valuable asset that helps ensure the long-term survival of the regime against external pressure. Ultimately, the sanctioned state profits not by maximizing its income in an open market, but by securing a baseline of revenue that allows it to endure. The discount it offers is the price it pays to access this illicit system, a cost of doing business in a hostile world. The other players, the ship owners, traders, refiners, may be motivated purely by financial gain, but their collective actions provide the sanctioned state with the one thing it needs most: a steady stream of cash. In this sense, the very system that enriches a host of shadowy middlemen also serves the fundamental interests of the regime the sanctions were meant to punish, creating a strange and symbiotic relationship born out of mutual necessity. Section 1. The two-tier market: visible versus invisible supply. Sanctions create a fracture in the global oil market, splitting it into two parallel systems. The first is the visible, legitimate market, the one we read about in financial news. Major oil companies, reputable traders, transparent pricing benchmarks. Brent, West Texas Intermediate. This market operates under a clear set of rules, with transactions tracked, insured, and regulated. When sanctions are imposed, they officially remove millions of barrels per day from this visible supply chain. Analysts adjust their spreadsheets. Headlines warn of a tighter market. potentially higher prices due to apparent scarcity. This is the market as it appears on paper. Beneath this official market, a second tier emerges, the invisible market, the shadow economy where sanctioned oil continues to flow. It doesn't show up in official supply statistics like the IEA's. Ghost ships that go dark, transactions financed through obscure channels, origins deliberately hidden. This invisible supply counteracts the reduction in the visible market. Official data suggests a supply deficit, but physical barrels remain much closer to pre-sanction levels. The oil is still there. It has gone underground, creating a major discrepancy between perception and reality. This two-tier system has profound consequences. It creates uncertainty and complicates forecasting for everyone. Governments, private companies, legitimate traders, refiners, facing incomplete and often misleading data. They see official supply numbers fall. They may not see a corresponding price surge, because invisible supply quietly fills the gap. This can lead to miscalculations and poor investment decisions. A refiner might invest in an expensive expansion based on the belief that supply will be tight, only to find the market flooded with cheap, laundered crude from the shadow fleet, undermining their entire business case. The bifurcated market institutionalizes a new class of players. Visible market, established giants. Invisible market, nimble, risk-tolerant operators. They thrive on the opacity sanctions create, not a temporary anomaly, a permanent feature of the global energy landscape. As long as major producers are sanctioned, this two-tier market will persist. One part operating in the light of regulation, the other thriving in the shadows of deception, constantly distorting our understanding of global supply and demand. Section 2. Price volatility and the geopolitical risk premium. The hidden flow of sanctioned oil doesn't just distort supply figures, it also injects a new level of volatility and unpredictability into global prices. On the surface, taking a major producer's oil off the market should lead to a simple outcome: higher, more stable prices due to lower supply. But the reality of the shadow market makes the situation far more complex. Prices become more sensitive to rumors, geopolitical tensions, whispers about sanctions enforcement. The market is constantly trying to guess how much invisible oil is actually making it to buyers and how secure that flow really is, leading to sudden price swings that have little to do with traditional supply and demand fundamentals. A key factor is the geopolitical risk premium. This is an extra amount that traders add to the price of oil to account for potential disruptions. Sanctions are a major driver of this premium. The risk that a conflict could escalate, or that sanctions enforcement could suddenly become much tougher and successfully remove barrels from the shadow market, makes traders nervous. For example, if a shadow fleet tanker is seized, or if there is a military incident near a key smuggling route, oil prices can spike instantly. This is not because supply has actually changed, but because the market fears it might. The shadow market's inherent instability becomes a source of global price instability. Let's look at a small example. Imagine the global price is $80 per barrel. News breaks that the U.S. Navy has increased patrols in a known ship-to-ship transfer zone. Suddenly, traders fear that a few million barrels of Iranian oil might be delayed or seized. In response, they bid the price of legitimate crude up to $83 per barrel. The risk premium has just added $3 to the cost of oil worldwide, even though not a single drop of oil has actually been stopped yet. This volatility makes it harder for businesses and consumers to plan. Airlines, shipping companies, trucking firms face fluctuating fuel costs, which they eventually pass on to consumers through higher ticket prices and more expensive goods. Conversely, the shadow market can also put a cap on prices. When prices for legitimate oil get too high, it makes the discounted sanctioned crude even more attractive. More buyers are tempted to take the risk, which increases the flow of invisible oil into the market. This extra supply can then help bring global prices back down. The shadow market acts as a strange, unregulated shock absorber. It introduces volatility through risk, but also provides a secret source of supply that can prevent prices from spiraling completely out of control. This creates a confusing and often contradictory market dynamic, where the hidden trade both fuels and tames price swings. Section 3. The Insurance Black Hole. Rising costs and unseen dangers. The shadow fleet's reliance on a parallel insurance system has consequences that extend far beyond the world of finance. It creates a massive safety and environmental liability on the high seas. The mainstream maritime insurance industry, centered around the international group of P&I clubs in London, provides coverage for everything from oil spills to collisions. These clubs have high standards. They require ships to be well maintained and operated safely. By refusing to cover any vessel involved in sanctions evasion, they force the shadow fleet to seek alternative, less reputable coverage, or, in some cases, to sail with no meaningful insurance at all. This creates a dangerous black hole of risk. When a legitimate, well-insured tanker is involved in an accident, there is a clear process. The P&I Club steps in, providing billions of dollars in coverage to fund cleanup operations, compensate victims, and manage the wreckage. When a shadow fleet tanker has an accident, the outcome is far more uncertain. The anonymous owner, hidden behind shell companies, is likely to simply abandon the vessel and its cargo. The alternative insurer, if one even exists, may not have the financial capacity or the willingness to cover the immense costs of a major oil spill. This leaves governments and taxpayers of the affected coastal state to foot the bill for the environmental catastrophe. This situation is not theoretical. The shadow fleet is primarily composed of older vessels, many of which are past their normal service life and have questionable maintenance records. They engage in risky behaviors like turning off their collision avoidance systems, conducting dangerous ship-to-ship transfers in rough seas. The probability of an accident is significantly higher than in the legitimate fleet. We are creating a situation where the riskiest ships carrying the most dangerous cargo have the worst insurance. It's a ticking time bomb, and coastal communities along major shipping routes are unknowingly living in the potential blast zone of an uninsured environmental disaster. This insurance black hole also has a ripple effect on the legitimate market. As the risks posed by the shadow fleet grow, mainstream insurers become more cautious. They may increase premiums for all vessels operating in regions where the shadow fleet is active, like Strait of Malacca or the Mediterranean. A legitimate ship that has done nothing wrong may see its costs rise simply because it is sharing the water with uninsured, unsafe ghost ships. This raises operating costs for the entire shipping industry, another hidden expense that is ultimately passed down the supply chain to consumers, all because sanctions have created a two-tier system for risk and responsibility. Section 4. Dirty Data. The challenge of tracking a hidden market. One of the most significant impacts of the sanctioned oil trade is the corruption of data. Traders, analysts, governments, and corporations rely on vast streams of data, from satellite tracking of ships to customs declarations. The shadow market's entire business model is based on destroying the integrity of this data. By falsifying documents, turning off transponders, and creating fake shipping histories. Think of the AIS tracking system. It was designed for safety and transparency. The shadow fleet has turned this system into a tool of deception. Analysts who use AIS data to model oil flows now have to contend with major gaps and outright lies. They see a ship disappear off the coast of Africa and reappear 2 weeks later in Asia, with its data log showing an impossible journey. Analysts must use complex algorithms and other surveillance tools like satellite imagery to try and guess what happened in the dark. What should be a straightforward analysis becomes a complex forensic investigation, and the conclusions are always subject to uncertainty. This dirty data problem extends to customs and trade statistics. When a refinery in China imports a cargo documented as Malaysian blend, it is recorded in official trade statistics as an import from Malaysia. In reality, the oil may have come from Iran. Malaysia's reported oil exports might appear much higher than what it can physically produce, while Iran's official exports appear artificially low. This distortion makes it nearly impossible for economists and policymakers to understand true trade balances and dependencies. The consequence is a loss of trust and an increase in risk for everyone. Market participants may demand higher risk premiums, reduce investment, or pull out of certain markets. It also makes sanctions enforcement a nightmare. How can you penalize a company for buying Iranian oil when all its paperwork says the oil came from Oman? The systematic degradation of data integrity is not just a technical problem. It is a direct assault on transparency and predictability, essential for a stable global market. Section 5. The Enforcement Dilemma. A losing game of whack-a-mole. For the countries trying to enforce sanctions, typically the US and its European allies, the shadow market presents an enormous and frustrating challenge. Enforcing sanctions in this environment is like playing a game of whack-a-mole. Every time they manage to penalize one ship, or one front company, two more pop up to take its place. Decentralized, anonymous, agile. The financial incentives are so powerful, there's always a new player willing to step in, making any enforcement victory feel temporary. The primary tool for enforcement is blacklisting, officially known as being placed on the Treasury Department's specially designated nationals list. This cuts off a person, company, ship from the U.S. financial system. However, players in the shadow market are experts at evading this. A blacklisted ship can be quickly reflagged under a new name. Its ownership can be transferred to a new, clean shell company. The original entity is discarded like a burner phone, and the operation continues with minimal disruption. Sanctioning authorities are constantly playing catch-up, trying to untangle complex corporate webs that were designed from the start to be untraceable. This enforcement dilemma creates a significant resource drain. Government agencies must dedicate teams of investigators, analysts, lawyers, to the painstaking work of tracking these illicit flows. They must invest in expensive satellite surveillance technology and data analytics platforms. Despite these efforts, they can only ever catch a fraction of the total activity. The sheer scale of the global shipping industry makes it impossible to monitor every vessel. Authorities are forced to focus on the most blatant offenders, knowing that for every ship they catch, dozens more are successfully completing their clandestine voyages. This constant cat-and-mouse game also raises difficult diplomatic questions. Much of the sanctioned oil ends up in countries that are not participating in the sanctions regime. To truly stop the flow, enforcing nations would have to impose secondary sanctions on the entities in those countries that are buying the oil, such as the private refiners in China. This is a major diplomatic step that can create friction with powerful economic partners, faced with the choice between confrontation and turning a blind eye. Enforcing countries often choose the latter. This tacit acceptance allows the shadow market to persist as a permanent, if unwelcome, feature of the global oil trade. Section 1. The Captain's Choice. A moral compass at sea. Let's call him Captain Eris. He is not a criminal mastermind. He is a 50-year-old mariner from the Philippines with a family to support and 30 years of experience at sea. For most of his career, he worked for reputable shipping lines, his life governed by schedules, safety protocols, international law. But the shipping industry is changing. Good, stable jobs are harder to find, especially for captains of his age. A few months ago, he was offered a position with a newly formed company registered in a country he had never heard of. The salary was almost double what he had ever earned before. The catch was unspoken, but he understood it. His new job was in the Shadow Fleet. His first voyage takes him to the South China Sea. His orders, delivered via an encrypted messaging app, are clear. He is to sail to a specific set of coordinates in international waters and wait. At the designated time, he is instructed to turn off his ship's automatic identification system, the AIS transponder. For a career mariner like Eris, this is a profound violation. The AIS is a lifeline, a tool that prevents collisions and keeps his crew safe. Going dark feels like closing his eyes while driving on a highway. He knows the risks. A collision with another vessel could lead to a catastrophic fire, a devastating oil spill. His crew, men he is responsible for, would be in mortal danger. Hours later, another tanker appears out of the darkness. It's an older ship, rust stains streaking its hull. The ship-to-ship transfer begins. As millions of barrels of crude oil are pumped onto his vessel, Eris looks at the paperwork. The certificate of origin is blank. He will be instructed to fill it in later, claiming the oil was loaded from a legitimate source. He knows this is a lie. He knows the oil is from a sanctioned nation. He also knows that his new employers are not people to be questioned. The safety of his crew and his ability to provide for his family back home depend on his compliance. He is trapped between his professional duty and his economic reality. This is the human face of the Shadow Fleet. Captain Eris is not a kingpin. He is a pawn in a much larger game. He doesn't see the millions in profit being made by the ship's anonymous owner, or the trader who structured the deal. He only sees the immediate choice in front of him: follow dangerous and illegal orders, or risk his job, risk his future, and potentially the safety of his family. For every clandestine voyage, there is a captain like Eris on the bridge, wrestling with their conscience. They are the essential and often expendable human element that makes this entire hidden system possible, navigating the dark waters of both the ocean and their own morality. Section 2. The Trader's Gamble. A phone call worth millions. In a sleek office high above the Dubai skyline, a man we'll call Jin makes a phone call. Jin is in his late 30s. He runs a small, discreet trading firm. He doesn't own oil wells or tankers. His only assets are a bankroll. His only assets are a list of trusted contacts. His only assets are an appetite for risk. He is a master of the margin. His specialty is sanctioned commodities. He is on the phone with a broker. A 2 million barrel cargo of crude oil is available for immediate loading from a sanctioned port. The seller is offering a $25 per barrel discount to Brent at $90. It's a chance to buy at $65 per barrel. Jin's mind works like a calculator. He quickly runs through the numbers. 2,000 barrels x $65, $130,000 purchase. He can find a private refiner in Asia who will buy it, once laundered, for about $85 barrel. That would be a $170,000 sale. Potential gross profit, $40,000. From that, subtract costs. He calls a shipping contact. He charters a Shadow Fleet tanker. Freight, an inflated $10,000. He budgets $2,000 for intermediaries handling fake paperwork, and for fees to move money through non-Western banks. Total costs, including oil, approximately $142,000. Potential net profit, $28,000. The risk, however, is immense. If the cargo is seized, he loses the $130,000 purchase. The tanker could suffer mechanical failure. The buyer could back out. His fortune and his freedom ride on this one deal. But Jin has done this before. He knows how to structure the deal to minimize exposure. Purchase via one shell company, shipping chartered by another. His name appears on no document.
He is a ghost in the machine, pulling strings from thousands of miles away. He tells the broker, "We have a deal." A real shadow market transaction is born, not a boardroom decision, a quick, high-stakes gamble by a single individual. We have a deal.
He is not motivated by politics or ideology. Sanctions are a market distortion, a predictable price gap. His job is to exploit that gap. One phone call sets in motion a chain of events involving a captain like Eris, a rusty tanker, and a web of deception spanning continents, all for the chance to capture that margin. Section 3, the refinery manager's dilemma, plausible deniability. Let's meet Mr. Chen, the procurement manager for a large, privately owned refinery in a coastal province of China. His job is to buy crude oil, the lifeblood of his company, at the lowest possible price. Every dollar he saves per barrel goes directly to the refinery's bottom line. The competition is fierce. State-owned giants have advantages he doesn't. To stay profitable, Mr. Chen has to be creative. One morning, he gets an email from a trading house he has worked with before, one known for its discretion. The offer is for a cargo of Malaysian blend crude, available for delivery next month. The price is suspiciously good, about $12 below the current market rate for similar grades. Mr. Chen knows exactly what this means. Malaysia does not produce enough of this type of oil to be exporting such a large cargo. Malaysian blend is often a code word in the industry for Iranian or Venezuelan oil that has been laundered through ship-to-ship transfers in the Strait of Malacca. The documents that will accompany the shipment, however, will be flawless. The certificate of origin will say Malaysia. The bill of lading will show a Malaysian port of loading. On paper, it is a perfectly legitimate transaction. His own government is not strictly enforcing the U.S. sanctions, creating a gray area where this business can operate. He faces a choice. He can reject the offer and buy legitimate crude on the open market at a much higher price. This would shrink his refinery's profit margins and might lead to questions from his bosses about his performance. Or he can accept the deal. He can accept the documents at face value and claim plausible deniability. If anyone ever asks, he can say his company did its due diligence, and the paperwork showed the cargo was legitimate. He would be taking advantage of an unspoken understanding. As long as the lie is well documented, no one will look too closely. The cheap crude would give his refinery a huge competitive edge. Mr. Chen approves the purchase. For him, it is a simple business decision. He is not breaking any of his country's laws. He is securing a vital resource for his company at a favorable price. He is not thinking about the geopolitical implications of undermining sanctions, nor the environmental risks of the shadow fleet that delivered the oil. He is the final link in the chain, the one who provides the ultimate destination for the laundered barrel. The trader's gamble pays off, and the refinery's profits rise, because Mr. Chen is willing to accept a convenient fiction, turning a blind eye to the oil's true story. Section 4. The Seafarer's Story, Caught in the Middle. Now consider the story of a young deckhand from Indonesia, Budi. At 22, his first contract on a tanker. He was promised adventure and a good wage to send back to his village. The reality is very different. The ship is old, the work is grueling. Safety standards are lax. The crew is a mix of nationalities. They are thousands of miles from home. They are dependent on this job. They rarely know their ship's true destination, or the nature of its cargo. They simply follow orders on board. The captain and officers follow orders from an anonymous owner. One night, Budi is woken and ordered on deck. The engines are off. The ship is drifting in the open ocean, far from land. Another tanker is alongside. The crew prepares for a ship-to-ship transfer. The air is thick with crude oil. Budi feels a knot of fear. The sea is choppy. The ships creak and rub against each other. Hoses snapping, sparks igniting fumes. Men crushed between hulls. He knows this is not normal. This is not safe. But he has no choice. To refuse is to risk being fired and blacklisted, or left stranded in a foreign port with no way home. The crew works 12 hours straight, pumping dark, heavy oil. They are exhausted, but they get the job done. Budi never knows where the oil came from, or where it's going. He is a tiny cog in a giant invisible machine. His monthly salary is a few $100s. He is risking his life in these operations. A trader he will never meet makes millions. A shipowner he will never know adds to their fortune. The crew are the human cost of the shadow market, bearing physical risks, receiving almost none of the rewards. Months later, the ship is detained in port for inspection. Authorities discover irregularities in logs and cargo documents. The crew, including Booty, is held for questioning. They are treated as suspects despite having no control. The owner disappears behind shell companies. The trader moves on to the next deal. The crew is left to face the consequences. Booty's story is common. Thousands of seafarers are trapped on ghost ships, underpaid, overworked, caught in the crossfire of a global economic conflict they do not understand. Section 5. The consumer's blind spot. Finally, let's look at the story from the perspective of an ordinary person, a commuter in a city far from the high seas. Let's call her Maria. She is a nurse. She drives 30 miles to work every day. Her budget is tight. The price of gasoline is one of her biggest weekly expenses. She sees news reports about sanctions on an oil-producing country and worries. She hears millions of barrels are being taken off the market and expects pump prices to skyrocket. Sometimes prices spike. Often increases are more moderate, or they soon fall back. Maria doesn't understand why. She is unaware the gasoline in her car might have started as a discounted, sanctioned barrel of crude. Mr. Chen's refinery bought that oil and processed it into gasoline. The gasoline was sold into the regional market. From there, it was mixed with other fuels. It moved through a complex supply chain. By the time it reaches Maria's local gas station, its illicit origins are untraceable. She is the unwitting final customer of the shadow market. She doesn't get a discount. The price she pays is the full market price, set by global benchmarks and local taxes. Profits made along the way are absorbed by middlemen: the trader, the shipowner, the refiner. The entire financial benefit of the sanctions discount has been absorbed by them. She may even be paying a slightly higher price because of the system. The shadow market's volatility and risk add a risk premium to all oil, raising the baseline price. Increased insurance costs for legitimate shippers and market uncertainty add pennies to every gallon. So while the shadow market can prevent a massive shock, it also creates a higher, more volatile price floor. This is the ultimate irony. Sanctions, meant as statecraft, create a hidden economy that enriches a few and has invisible consequences for everyone else. Maria filling up her car is disconnected from Captain Eris on his dark ship, the trader Jin making his gamble, the seafarer Booty risking his life. She only sees the final number on the pump. The human stories, moral compromises, and immense profits remain hidden, buried deep within the price of a gallon of gas. Section 1. We began with a simple idea. Sanctions don't stop oil. They just make it more profitable for a select few. Throughout this journey, we have followed the money trail, peeling back the layers of a clandestine system. A policy designed to isolate and punish nations inadvertently creates a thriving shadow economy. This hidden market operates on a simple principle. A sanctioned country desperate to sell oil offers it at a deep discount. That discount is the fuel for the illicit chain. The key findings are clear. A new class of winners has emerged capitalizing on opacity. First, shadow shipowners, anonymous figures, a growing fleet of aging tankers. They charge enormous premiums to move risky cargo. Next, risk-hungry traders, intermediaries. They buy low, launder the cargo's identity, sell high. To buyers who look the other way, their profit is the margin between discounted and market price. The trail ends with compliant refiners, often in Asia, final destination for laundered crude. Cheaper feedstock gives them a big competitive advantage and higher profits over law-abiding rivals. Supporting all this, enablers, alternative insurers, secretive banks. The ecosystem relies on deception, disappearing ships, ship-to-ship transfers at sea, forged documents. The result, a parallel market that undermines sanctions. Official supply may appear to shrink, but physical supply stays steadier as millions of barrels flow through hidden channels. That distorts data, creates volatility, and obscures global energy flows. The sanctioned state, though losing some revenue, secures a lifeline of cash to survive and resist pressure. The shadow economy born from sanctions is now a permanent, disruptive feature of our world. Section 2. The existence and growth of this shadow market force us to confront a series of difficult policy and ethical questions. If the primary goal of sanctions is to cut off a regime's revenue, but this system allows them to continue selling their most valuable commodity, how effective is this tool really? We have seen that the sanctioned state survives while a host of shadowy middlemen get rich. Does the economic pain achieve political change, or does it create wealthy beneficiaries with a vested interest in ongoing conflict? We must also ask about the ethical compromises at every step. We have seen the human stories behind the headlines. The ship captain forced to choose between safety and his livelihood, the young seafarer risking his life for a meager wage. The system preys on the vulnerable, while the architects of the deals remain shielded by corporate anonymity. Is it ethical to pursue a policy that creates perilous working conditions and leaves crews stranded while owners escape accountability? The environmental risks demand our attention. The shadow fleet is older, poorly maintained vessels often sailing with inadequate or no insurance. They perform dangerous maneuvers at night, increasing the chance of a catastrophic oil spill. Who will pay for the cleanup when a ghost ship causes disaster? Anonymous owners vanish, leaving coastal nations and taxpayers to bear the cost. Are we trading a geopolitical problem for an environmental catastrophe we're unprepared to handle? Finally, enforcement is a dilemma. The current strategy is a losing game of whack-a-mole with authorities always one step behind. Is there a better way? Should we shift from stopping every barrel to targeting the key enablers, financial institutions, alternative insurers, corporate service agents? And what about the countries whose ports and refineries receive this oil? Their tacit acceptance is the final link that keeps the system profitable. Section 3. Acknowledging the shortcomings of the current system is the first step toward finding potential remedies. A more effective approach would require a multi-pronged strategy focused on increasing transparency and international cooperation. The loopholes that the shadow market exploits, anonymous ship ownership, flags of convenience, are not new problems. Closing them would require a concerted global effort. Stricter enforcement requiring true beneficial owners to be publicly registered would make it much harder for the kings of the clandestine seas to hide. It would attach a name and a face to the risk. Improving tracking and data analysis is also critical. While the shadow fleet is skilled at deception, technology offers new ways to fight back. Satellite surveillance, artificial intelligence, data sharing among nations. By flagging suspicious behaviors in real time, ships going dark in known transfer zones, broadcasting impossible travel histories, authorities could move from reactive to proactive enforcement. This would involve creating and sharing a global database of vessels and companies engaged in illicit activities. Ultimately, the most powerful tool is international cooperation, especially with the countries that are the primary destinations for sanctioned oil. This is a delicate diplomatic challenge. It means moving beyond just imposing sanctions and working to convince major buyers, China, India, that a stable, transparent, and rules-based energy market is in their long-term interest as well. This could involve a combination of diplomatic pressure and incentives, encouraging them to crack down on private refiners who knowingly purchase laundered crude. Without a final destination, the entire illicit supply chain would collapse. Sanctions may not stop the oil, but they do change who profits from it. The hidden winners, ship owners, traders, refiners, thrive on secrecy and thrive on risk. The path forward must be one that shines a bright light into these dark corners of the global economy. Greater transparency, tougher enforcement on the enablers, and stronger international partnerships are essential to dismantling this shadow market. A deep discount on a barrel of oil in a remote ocean at night, isolated transfer zone at sea. There will always be someone willing to profit from the chaos, leaving the rest of us to deal with the consequences.